Hello! Now this video is the first in a series on basic accounting. Now I do want to make something very clear. These videos are aimed at the novice. So that could be someone in high school that's taking an accounting course for the first time, or an undergraduate student taking an accounting course for the very first time, or more likely just someone out in the general population that would like to know a little bit more about the very basics of accounting. I am not going to be going into the deep weeds of accounting, where it's very complex and very deep and things like that. So this is just going to be the basic ideas to help you get a better understanding of what accounting is. Now with that being said, let's go ahead and continue. In this video, I'm going to be talking about the three fundamental business activities: financing, operating, and investing. And whether you think about it or not, these things are occurring around you all the time. Not only when you go out and patronize a business, but also in your own personal life when you handle your own finances. There are corollaries between the larger economic system and the way a business works and the way our households work. And I'm going to try to point out where things are similar. So what is the role of accounting? And this list is not exhaustive by any means. But basically, businesses are doing the three fundamental activities: financing, investing, and operating. And that generates a tremendous amount of financial data. Think of a huge company like Walmart. Think of the sales data that they generate just in one day. Think about the inventory they have to order on a regular basis. That is a tremendous amount of information. Now, there are numerous stakeholders that need that information. If I want to buy Walmart's stock, I want to know how the business is performing. If I am a bank, like JP Morgan, that may want to lend money to Walmart, I want to know how Walmart is doing financially. So there are many different kinds of institutions and people that need this information, and they need it quickly and accurately. So accountants assist in generating reports that summarize that data, sort of the financial condition of a business. So it's like going into your doctor, and your doctor does a checkup and says, okay, everything's doing okay, you might want to try this, things like that. So it's just a financial checkup of the business. And this can be over a series of months or even years, or they can be a snapshot, just a click of a moment in time, and they can take both forms. So accountants assist in generating these reports, among many other things. And as far as these reports go, there are four basic statements that accountants prepare, and I'm sure you've heard of one or more of these. They help prepare the income statement, what's called the retained earnings statement, the balance sheet, and the statement of cash flows. Now we're going to talk more about each one in more detail in later videos. But just keep in mind that accountants have to manage and organize large amount of financial data, summarize it into reports for stakeholders such as owners and shareholders and stuff like that, and they have to do it accurately and quickly. So here are our three fundamental business activities: investing, financing, and operating. So you can think of it as the FIO model: financing, investing, and operating. So we're going to use an example to talk about exactly how this plays out in real life as far as setting up a business. So we have a woman whose name is Sue, and she is interested in opening up a high-end, full-service salon. And this salon is going to be adjacent to a local business park. And her idea is that since numerous executives and other important individuals traverse the area on a consistent basis, she feels like this business park is an untapped market for her services because there is no one else around in that business that's that convenient. Now, in addition to her personal savings, Sue is going to have to apply for a small business loan through the SBA and or her local bank in order to get the business up and running. And that would include things like maybe signing a lease, hiring a lawyer to have some legal advice as she sets up her business. She may have to buy some equipment for her business. She may have to remodel an existing building if she doesn't, build her own, whatever. You get the idea. She's going to have some money for startup costs. When Sue goes to borrow money, she is entering the capital market. She's going to be borrowing someone else's capital. And that's one of the fundamental things about economics, is that a borrower is interacting with a saver. So when someone borrows, they are borrowing from someone who has saved. And that is a very basic way of thinking about a capital market. So what types of basic financing are there? And I'm sure you're probably familiar with all of these on some level as well. Well, we can borrow money, which are loans. So we borrow money to buy cars, we borrow money to buy houses, we borrow lots of money to go to college. So we can get financing by borrowing through loans. We can get financing through equity. So if we're a large public corporation, we can issue shares of stock. And I'm sure everyone has heard of a share of stock. The company issues stock, and we give the company money for that share of stock. So in theory, we own, quote, part of the business that we can then redeem at a later point if we choose. Or for a private company, we can sell private stakes in our business to an investor, and then they would be entitled to a certain percentage of our profits. There are many ways to organize it, but equity is one way. And then the last way, which is usually reserved for very large corporations, is issuing debt in the form of like corporate bonds. So if a company needs to raise money, they can issue a bond, which basically says that you give us a certain amount of money and we will pay you that money back with interest on certain terms. And that could be lots of different terms. So we can borrow through loans. We can raise money through equity by selling shares of stock or selling a private stake in our business. Or in the case of larger corporations, not Sue's case necessarily, but in larger corporations, we could issue corporate bonds. In later videos, we will talk about each financing activity in more depth. But keep in mind that whenever someone taps the capital market, whether it's they borrow money, they issue stock, or issue bonds, they're also creating a matching, what we call a liability. And that just means those have to be paid back. So loans have to be paid back at some point. That's a liability. Stock could be redeemed at any time. Bonds obviously will have to be paid back with interest at some point. So that is a liability. And this is a very important concept in accounting. Every transaction has a matching transaction in some way. And we'll talk about that more later. So let's go ahead and pick up with Sue. So once Sue has the necessary financing, she will have to decide how to put those funds to work. So she decides to use that starting capital, which is her savings and her loans, to get some legal advice, set up her business license, get insurance, and get a lawyer to help her, structure her business within the law and, of course, to protect herself in terms of liability. Maybe she'll build a building on her own, or she'll purchase a long-term lease with an existing building. She's going to do some remodeling, which would include painting, getting new fixtures and furniture inside the building. She will have to buy some equipment, so computers, cash registers, and phones to go in the salon. And she will have some initial marketing costs. So she may put some ads in newspapers. She may do some other advertising, maybe on a billboard. And she will set up some social media accounts, whether that's a Facebook page or something on a Twitter account or things like that, a basic web page. So she will have to turn the money she got from herself, her own savings, and the bank into the following assets. And that's just to get her business off the ground. Now, as far as operating activity goes, since Sue is operating a salon and day spa, almost all of her income, almost all of her money coming in is from providing services as opposed to, selling a product. So if I go to the grocery store, I am buying products. If I go to a day spa, I am buying a service. Now, there will be some product sales at the salon because she has contracts with certain vendors to sell, hairspray and body lotion and things like that. But that will be just a smaller part of the business. Now, while operating, the salon will incur costs, of course. She will have to pay wages to employees. She will have to pay utilities such as water and electric. She will have to pay maintenance costs on the building and the equipment and whatever else. She'll have to pay rent, obviously. She'll have some advertising costs. And, of course, the obligatory Starbucks runs. Now, if Sue's revenues, the money that comes in, exceeds her expenses over a set period of time, say like a month, then the salon will have a positive net income. And I think we all intuitively get that idea. So if you take in more in sales than you spend in expenses, then you're going to have a positive net income, which is a very good thing. Okay, so let's review very quickly before we end this video. Just remember that there are three fundamental business activities: investing, financing, and operating. Now, the financing aspect is largely how businesses raise capital, money or cash being one of those types of assets, to start themselves or to fund their everyday business activities. Investing is oftentimes the purchase of assets like cash registers or equipment, or sometimes it's land. It just depends on the type of building. And of course, operating is sort of the day-to-day running of the business. So we have costs associated with running our business, but we also have, hopefully, sales coming in. So all three of those gears, and I picked this gear graphic for a reason, because they all work together as an overall unit. And once we talk about certain financial statements, you'll really see how all three of these tie into each other in sort of a web. Okay, so I think that just about covers it for this video. But just be thinking about those three things: financing, operating, and investing. Thank you for watching, and I will see you next time.